Viewers at home, you are welcome to my presentation on cost of capital. This is the extension of my lectures on cost of capital. I will advise you to go over the part 1, the calculation of cost of equity. So in this presentation, I will examine the cost of preference shares, the cost of preference shares, the cost of debt capital, both redeemable, irredeemable and convertible. I will as well consider the cost of not traded debt. So I'm starting with the cost of preference shares, cost of irredeemable preference shares, cost of irredeemable preference shares. Cost of irredeemable preference shares. So, cost of irredeemable preference shares is the minimum rate of return required by preference shareholders in order to maintain their existing market price. The minimum required rate of returns by preference shareholders in order to maintain their existing market price is said to be the cost of preference shares. Since preference shares usually have a constant dividend, the same approach used in estimating the cost of equity shares with no growth in dividend will be used in estimating the cost of preference shares. So, I've told you that since the preference shares usually have a constant dividend, the same approach used in estimating the cost of equity shares with no growth in dividends will be used in estimating the cost of preference shares. So the cost of preference shares, denoted represented by KP, cost of preference shares, equal to dividend over market value of preference shares times 100. Dividend over the market value. I've told you that this market value of preference share must be SDIV. It must be SDIV. The KP stands for cost of preference share. The D stands for the current dividend paid or payable. Current dividend paid or payable. Current dividend paid or payable. Market value of preference shares. Market value of preference shares. That is SDIV market value of preference shares. X D market value of preference shares. SDIV market value of preference shares. I've told you that where there are outstanding dividend, that means the given market value will be cum div. Cum div means there are certain dividends that have not been paid. That is, outstanding dividend is included in the market price. So to calculate the SDIV, you deduct the outstanding dividend from the market price in order to get the SDIV market price. So that is for that. We want to take question as work example. A company has 50,000 8% preference shares in EU. Nominal value $1. The current SDIV market value is $1.20 per share. What is the cost of preference shares? That is the question. So you want to calculate the cost of preference shares. You are given the coupon rate to be 8%. The coupon rate of the preference shares is 8%, and the market value is 1.20. So, and you want to calculate the cost of preference shares. And you have been told that the market value of 1.2, we were told it is X deep. And I've told you that the market value must be X deep. Therefore, you want to calculate the cost of preference share. So, we have cost of preference share equal to dividend over market value of preference shares times 100. I've told you that the market value must be X deep. So the dividend rate is 8%. Dividend rate is 8%. And the XD market value, the market value of preference shares XD, and it's given to be $1.20. So your percent is equivalent to cent or 100. So this one you can convert it to cent too. So we have 1.20 times 100. So that will give us 120 cents. That is 120 kobo in Nigeria context. So it will be 120 kobo. So the cost of preference share, the dividend is 8 over the market value 120 times 100. So 8 divided by 120 times 100, 8 times 100 divided by 120. Then you have 6.67%. The cost of preference shares is 6.67%. That is the cost of the preference share. We want to consider cost of debt. 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 So the debt capital, I will categorize it into two. Debt capital, we will categorize that into two. We have the traded debt and not traded debt. Not traded. Traded and not traded debt. So for traded debt, we will categorize that into three. We have irredeemable. 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 Then we have redeemable and convertible. That is for traded debt. Irredeemable, redeemable, and convertible. The non-traded debt, we have bank loan. Bank loan is an example of non-traded debt. So we want to start with the cost of irredeemable debt. So the terms such as bonds, loan stocks, loan notes, debenture, and marketable debts may be used interchangeably. The terms such as loan stock, loan notes, debenture, and marketable debts may be used interchangeably. So we want to start with the cost of irredeemable debt. Cost of irredeemable debt. Cost of irredeemable. Cost of irredeemable debt. Cost of irredeemable debt. So, irredeemable debt are the debt whose principal cannot be repaid. Their principal cannot be repaid, but its interest will be paid till perpetuity. The principal of an irredeemable debt cannot be repaid, but the interest of such debt will be paid forever. So we regard that as an irredeemable debt. Irredeemable debt, I said their principal cannot be repaid, cannot be redeemed. They cannot be redeemed to buy back, just like Redeemed Church. Their principal cannot be redeemed, but their interest will be paid forever till perpetuity. Therefore, cost of irredeemable debt, cost of irredeemable debt or debenture, cost of irredeemable debt or cost of irredeemable debenture is the minimum required rate of returns, required by debenture holders in order to maintain their existing market value. The minimum rate of returns required by the debenture holders in order to maintain their existing market value. So the calculation of the cost of debt, we can have pre-tax cost of debt. Pre-tax cost of debt, we have cost of debt equal to interest over market value of debt times 100. Interest over market value, where I is market value. I is market value, market value. I mean, where I is interest. I is interest. MVD, that is XD, as interest market value of debt, as interest market value of debt. And KD represent cost of debt. I've told you that pre-tax cost of debt is calculated using this formula: interest over market value of debt. And the I stands for interest, MVD stands for market value of debt, and KD stands for the cost of debt. You may also be required to calculate the post-tax cost of debt. Post-tax cost of debt, where KDs remain as cost of debt. We have interest into 1 minus tax rate over market value of debt times 100. That is post-tax cost of debt. The two formula I've given is for an irredeemable debt. The T stands for tax rate. T is tax rate, that is the corporation tax rate. So I've told you that the first formula is for calculating the cost of irredeemable debt. Pre-tax cost of debt, while this latter one is for post-tax cost of irredeemable debt. So the T in this formula represents tax rate. So what you need is the market value of debt, and this MVD represents as interest market value of debt. So we want to take question as work example. A company has irredeemable loan notes currently trading at $50 x interest. The coupon rate is 8% and the rate of corporation tax is $30. A. What is the return required by the debt provider? The pre-tax cost of debt. the coupon rate, that is interest rate, is 8%, and the market value is $50. Therefore, you want to calculate pre-tax cost of debt. I've told you that the formula for calculating the pre-tax cost of debt equal to interest over market value of debt x interest. So the interest rate is 8% and the market value is $50 times 100. So that will give us 8 divided by 50 times 100. That will give us 16%. Cost of debt is 16%. So that is for pre-tax. That is the requirement A. B. In the B aspect, what is the post-tax cost of debt to the company? What is the post-tax cost of debt to the company? You want to calculate the post-tax cost of debt. Post-tax cost of debt. So to calculate post-tax cost of debt, post-tax cost of debt, I told you that the formula is cost of debt equal to interest into 1 minus tax rate over the market value of debt times 100. That is the formula for calculating the post-tax cost of debt. Interest rate is 8%. 1 minus tax rate is given to be 30%, which is 0.3 over the market value of debt. And the market value of debt is $50 times 100. So if you have 8, 1 minus 0.3 will be 0.7. Is 0.7. So 0.7 times 8. That will give us 5.6. 5.6 divided by 50 times 100. Then you have 11.2%. 11.2%. Therefore, the post-tax cost of debt is 11.2%. If you don't want to use that formula, since you have calculated the pre-tax cost of debt and you've got 16%, to get the post-tax cost of debt, your post-tax cost of debt, that will be pre-tax cost of debt into 1 minus tax rate. Into 1 minus tax rate. And our pre-tax cost of debt have been calculated above. We got 16%. So you can now have 16% into 1 minus tax rate, which is 30%. So 1 minus 0.3, that will be 0.7. 0.7 times 16. Then you have 11.2%. That is the post-tax cost of debt. Post-tax cost of debt. Now, having considered the cost of irredeemable, the reason for the use of that formula is because the debt is an irredeemable debt, irredeemable loan. So we now want to consider the cost of a redeemable debt where it is redeemable. So that is the one we want to consider now. What do you mean by a redeemable debt? A redeemable debt are the interest. There are interest paid until repayment or redemption of the principal. So that means the principal can be redeemed or repaid. I've told you that for an irredeemable debt, their principal cannot be repaid. So we are on redeemable debt. I've told you that for an irredeemable, we said their principal cannot be repaid. But this one, interest will be paid till the principal are repaid. Interest paid until the repayment or redemption of the principal. That is for irredeemable. Interest will be paid until the principal are to be redeemed or repaid. So, I want you to take note of this. Debt is always quoted in $100. In Nigeria context, 100 kobo nominal. 2, the interest rate is always stated as a percentage of nominal value called coupon rate. The interest rate is always stated as a percentage of the nominal value called the coupon rate. So cost of redeemable debenture or cost of redeemable debenture or redeemable debt. Cost of redeemable debenture is the rate of interest which will be the internal rate of returns, which equate the current market value with the discounted future cash receipts of the security. The rate of interest which equates the current market value with the discounted future cash receipts of the security. So anytime you are to calculate the cost of a redeemable debt or debenture, you calculate the IRR, internal rate of returns. So you calculate the internal rates of returns, IRR. So that is what is expected of you whenever you have to calculate the cost of a redeemable debt or loans or debenture. Now, to calculate IRR, you will need 2 costs of capital. 2 costs of capital will be required, and 2 net present value will be required. Before you can even calculate the cost of a present value, then you will need the cash flows. The following are the cash flows you will require or needed for the calculation of the cost of a redeemable debt. Number 1, you will need the market value. Market value. This market value of the loans or debt, of a redeemable loans or debt, will be used in year 0. Year 0 as an outflow. Outflow in year 0. It will be used as an outflow in year 0. Then you will need the annual interest. Annual interest payable till the redemption of the debt. The interest that will be payable annually, calculated using coupon rate. This interest will be calculated using the coupon rate, or you may just use the coupon rate. The third cash flows is the redemption or repayment value, the amount that will be repaid, the capital repayment. This amount will be, let me say, capital repayment. This amount will be repaid at the expiration of the time or period of the loans or debenture. Number 4, tax savings on interest. Tax savings, the amount of tax that will be saved. Remember, the interest on loans or debenture will be treated as a finance cost in the statement of profit or loss. Since that interest will be treated as finance cost, that means it will reduce the profit. Since the profit will be reduced by the amount of the interest, then the tax will be reduced by the amount of interest on the loans or debenture. So you are going to discount these cash flows. You discount the cash flows to get the net present value. That means you are going to have, for your IRR or the NPV, you have year 0. Let me have the items. In year 0, I've told you you have the market value. The market value. Then year 1 to the end of the period, then you have the annual interest. Then year 1 to the end of the period also, you have the tax savings on the interest. That tax savings, you apply the rate of tax on your interest, then you treat it as an outflow. Then at the end of the period, you have capital repayment. So the cash flows. So you have this as an outflow, the market value as an outflow, inflow, tax savings on interest as an outflows, the capital repayment, the capital that will be repaid, then you have that as an outflows, as an inflows, capital repayment as an inflows at the end of the period. Then you discount these cash flows to get their present value. To get the present value. So the sum of the present value, then you use it to calculate the net present value. The net present value. And I've told you that for the purpose of IRR, two NPV will be calculated. One must be positive, the other one must be negative. If the first one is positive, to get the negative NPV, you use the rate, you increase the rate that is higher than the initial rate you have used. And if it is negative, you use lower rate to get the positive one. So I've told you that two NPV will be calculated. One must be positive, the other one must be negative. Now, you now use the interpolation to calculate your IRR, internal rate of returns. So internal rate of returns, we have lower rate, the lower rate, plus the net present value at that lower rate, over the net present value at that same lower rate, minus the net present value at the higher rate. Then we have higher rate minus lower rate. So that is the formula by interpolation. That is the formula to use in the calculation of our net present value. So we want to take question as work example. So a company has in issue 12% redeemable debt. You know, this is redeemable. It's different from irredeemable. I've told you that for an irredeemable, then you make use of the formula I've given you for irredeemable. But because it is redeemable, that means you want to use the internal rate of returns. So, has in issue 12% redeemable debt with 5 years to redemption. With 5 years to redemption. Redemption is at par. Redemption is at par. The current market value of the debt is $107.59. The corporation tax rate is 30%. What is the cost of debt to the company? That is, you have to calculate the post-tax cost of debt. So you want to calculate the post-tax cost of debt. You have been given the market value. I've told you that to calculate the post-tax cost of debt, that means you want to calculate the internal rate of returns, since it is a redeemable debt. I've told you that for a redeemable debt, you calculate the internal rate of returns. So, I've told you that you identify the cash flows. Then, number one, we have annual interest. Interest, which is 12%. So, you want to calculate IRR. To calculate IRR, then you first of all calculate the net present value. So, we have year. Then we have items. You have is year 0. I've told you that for year 0, you are going to use market value. Market value. Then you have the cash flows. Then the market value of the redeemable debt is given to be 107.59. That is the market value. So that is market value. 107.59 in year 0 as an outflow. Then the debt will be redeemable in 5 years. It will be redeemable in 5 years. And the coupon rate, the rate of interest is 12%. So it will be redeemable in 5 years. Then you have year 1 to 5. Then you have interest. Interest rate is 12%. 12%. Then same year 1 to 5. You have tax savings on interest. Tax savings on interest. At the tax rate is given to be 30%. Tax rate is given to be 30%. So you calculate 30% of 12. 30% of 12. Then that gives us 3.6. 3.6 as outflow. Then at the end of the period, you repay the capital repayment. How much will be repaid at the end of the period? The amount that will be repaid at the end of that 5 years. You were told it is redeemable at par. Redemption is at par. I've told you that debentures or loans that they are denominated into 100. Debt is always quoted in 100 nominal. So that means you are going to have the par value will be 100. Par value will be 100. Par value will be 100. Then you now discount it. Let's assume a cost of capital. You are going to use trial and error method. Let's try 5%. Discount factor at 5%. We assume that 5%. So in year 0, we have 1. Discount factor at 5%. 1 divided by 1.05. We have 0. So sorry, it's this cumulative you need for 5 years. Year 1 to 5, you use the annuity formula, which is 1 minus 1 plus r raised to power minus n over r. You make use of that formula since you need year 1 to 5. So, and if you apply that formula, raised to power minus 5 minus 1 divided by 0.05. Then that gives us 4.3295. Same for this. 4.3295. Then for year 5, we may use of this formula, 1 plus r raised to power minus n. Since it is only year 5 you need, 1.05 raised to power minus 5. Then we have 0.7835. 0.7835. Then what will be the present value of that? Present value. So this times this will be, you still have 107.59. 12 times 4.3295. Then we have 51.954. Then 3.6 times 4.3295. That will give us minus 15.5862. Then 100 times 0.7835. Then we have 78.35. Then the net present value now. Net present value. So this minus this 50.5862 plus 51.954 minus 107.59. Then we have 7.1278. We have positive NPV. Positive NPV of 7.1278. Since our net present value is positive, then you also calculate another NPV that will be negative. I told you that for the purpose of IRR, 2 net present value will be required. One positive another one negative. So we have here items, cash flows. So here 0, the market value, and that is 107.59. Here 1 to 5, we have interest of 12. Here 1 to 5 as well, we have tax savings on interest of 3.6. Then year 5, we have the capital repayment or redemption value, which is 100. So we now let's try another discount factor. Since our first NPV is positive, to get a negative one, you use a rate that is higher than the initial rate. And the rate we used for the first one was 5%. So now let's try 10% for this now at 10%. So we have the present value will still be 107.59. Then let's try cumulative, the same formula. The same formula we use. Since we need that of year 1 to 5, we are still going to use this formula. But we want to try 10%. This to power minus 5 minus 1 divided by 0.0 and divided by 0.1. Then we have 3.7908. Then this one will still be the same, 3.7908. We need that of year 5 alone for this. 1 divided by then this will be 0.6209. So the present value of this will be 62.09. 62.09. Then 3.6 times 3.7908. 3.7908. Then we have 13.6469. 6469 negative. Then 12 times 3.7908. Then we have 45.4896. So when you sum up this, so minus 107.59 minus 13.6469 plus 62.09. Then you have minus 13.6573. 6573 negative. So this NPV is negative. So we've got two NPV, one positive and the other one negative. So now we want to calculate IRR. We want to calculate the internal rate of returns. I've told you that for the purpose of IRR that we needed two rates, and two rates have been used. We've tried 5% and we've equally tried 10%. So now IRR, internal rate of returns by interpolation. So IRR, the formula is lower rate plus the net present value at the lower rate over the net present value at the lower rate minus net present value at higher rate. Then we have multiply by higher rate minus lower rate. The lower rate we have used is 5%. 5% plus the net present value at 5%. We have 7.1278. 7.1278. So that is our net present value. 7.1278 over 7.1278 minus the net present value at higher rate have been calculated to be 13.6573. 13.6573. So we have a minus is minus 13.6573, and that minus we change this minus times minus. If you have minus 13.6573, 13.6573. So we have to multiply by the higher rate is 10 and the lower rate is 5. So we have 5 plus. So if you have this one will be 7.1278 multiplied by 10 minus 5 will be 5 over the minus times minus will become plus. That means you are going to sum up the denominator. 7.1278 plus 13.6573, and that will give us 20.7851. So we have 5 plus. If you have 7.1278 times 5 divided by 20.7851, then we have 1.71. So if you sum it up, you have 6.71%. Therefore, IRR is 6.71%. That is the internal rate of returns. So that is the cost of redeemable preference shares. The cost of redeemable preference shares. So the next one is cost of convertible debt. Cost of convertible debt. Convertible debenture are loans or debenture that may be converted to equity. Those loans or debenture that may be converted to equity are said to be the convertible debentures. I've told you that they are the loans or debenture which may be converted to equity. That is convertible debenture. So they are loans or debenture that may be converted to equity. So convertible debenture is a form of loans that allows the investor to choose between taking the redemption proceeds or converting the loan note to equity. Convertible debenture. I've told you that those ones that may be converted to equity are said to be the convertible debenture. I said the investor may choose between the repayment or redemption or to convert them to equity. So if the investor want to choose between redemption, that is to repay that loans on maturity, or to convert them to equity. So ordinarily the investor will prefer to choose the higher of these two. Is it the redemption that will fetch him much returns, or the conversion? So the investor will choose the higher of the two. I've told you that convertible debenture is a form of loans that allow the investor to choose between taking the redemption proceed or converting the loan note to equity shares. So the procedures that you will need to follow in calculating the cost of convertible debenture. The first step is to calculate the value of conversion option from the available data. Calculate the value of the conversion option from the available data. Calculate the value of the conversion option. Don't forget, you want to choose between redemption, that is repayment, or to convert them to equity. So that is why you will need to calculate the value of conversion option. That is, how much will be the value if you convert them to equity. So you will need to determine that. Step 2. Compare the conversion option with cash option. Compare the conversion option with the cash option. So you want to compare this with this. You compare the conversion option with cash option. Assume all investors will choose the option with the higher value. The higher of these two will be chosen by the investor. Number 3. Calculate the IRR of the cash flows. Calculate the internal rates of returns of the cash flows, like that of the redeemable debt, like that of the redeemable debt. Don't forget, I've explained the cash flows that will be used for the purpose of IRR. So note, there is no cash effect. There is no tax effect whichever option is chosen at the date of conversion. No tax effect. Whichever option you use has no tax effect. So that is cost. Those are the procedures you need to follow when calculating the cost of convertible debt or convertible debenture. So we therefore want to take question as work example. So we want to take a question as work example. Example: a company has issued convertible loan notes. A company has issued convertible loan notes which are due to be redeemed at a 5% premium. This one will be repaid at 5% premium. That means the par value is 100. So premium now, it will not be, the amount that will be repaid will be 105. 5% premium in 5 years time. The coupon rate is 8% and current market value is 85. Alternatively, the investor can choose to convert each loan note into 20 shares in 5 years time. The company pays tax at 30% per annum. The company pays tax at 30% per annum. So you want to calculate the cost of convertible debt. So the first thing to do, I've told you that there are two things you have to compare: the cash option and the conversion option. If this debt, if it is to be settled on maturity, how much will be settled in cash? So the redemption value now, no, it will be redeemed at par, at a premium, premium of 5%. So the redemption value now, we want to compare it with the conversion value. So redemption value, redemption value, and that will be, since it is at a premium, I've told you that the nominal value is always 100. Premium 5%, so 1 plus 0.5, that is 1.05. That means the redemption value will be 105. So the 105 will be repaid on maturity in 5 years time. Now if they convert it to shares, how much will be the value in 5 years time? So conversion value, and that will be the conversion value. So now, in 5 years time, the coupon rate is 8%, and current market value is $85. Alternatively, the investor can choose to convert each loan note into 20 shares in 5 years time. So that means they will convert it to 20 shares in 5 years time. So the company pays tax at 30% per annum. The company, okay, there is a extension of the question. So the company pays tax at 30% per annum. So the company shares are currently worth $4, and their value is expected to grow at a rate of 7% per annum. So expected to grow at a rate of 7% per annum. Find the postal cost of convertible debt to the company. You want to calculate the postal cost of the convertible debt. You know, we want to convert it to shares. Now, conversion value now. Now, we have, it will be converted to 20 shares. 20 shares. 20 shares multiplied by the market value of the company is $4. The market value is $4. The currently worth $4. The company shares are currently worth $4. So the market value is $4. So we have multiplied by 4. So that will be 80. 20 times 4, that will be 80. And their value is expected to grow at 7% per annum. So if it grows at 7% now per annum, so in 5 years now, what will be their value? You need to calculate the future value. 7%, 1.07, 7% in 5 years. So you calculate the value, the future value. That is the value at the end of the 5 years. So now that will be 1.07. 1.07 raised to power 5. Then you have 1.4025 multiplied by 20 multiplied by 4. That is 80 times 80. Then you have 112.2. So you have $112.20. $0.20. That is the conversion value. If they convert that loans to shares, the value will be 112.20 at the end of 5 years. But if they wait till the maturity for the loan to be repaid, so it will be $105. So the highest of the two is $112.20. Ordinarily, you would like to choose that. So that means that will be the value you are going to use at the end of the period. So we now want to calculate the present value. Year, the items, then year 0, you have the market value. Market value, the cash flows. The market value of the company, the coupon rate is 8%, and the current market value is $85. So the market value is $85. So we are going to have $85 outflow in year 0. Then it will be repaid it will be converted to shares in 5 years time. So the conversion, the annual interest is 8%. Annual interest is 8%. So we have 8%. That is interest. 8%. Then the tax savings on interest. Tax savings. The tax rate is 30%. Tax rate is 30%. So 30% and 30%. You calculate 30% of the interest. That will be 2.4. 8 times 0.3. That will give us 2.4. So we treat that as an outflows. At the end of 5 years, you have capital. You now have conversion value. Conversion value. It will be converted to shares, and the value is 112.2. 112.2. So now you discount it. By trial and error, let's try 5% as well. Discount factor at 5% cost of capital. So yeah, this will be 1. So the present value, so 85 times 1 will still be 85 outflows. 85 outflows. Then we also have the cumulative. I've told you that you apply this formula. 1 minus 1 plus r raised to power minus n over r for 5 years. Now, r is 5%. So for 5 years as calculated the other time, or let's calculate it, 1.05 raised to power minus 5, 1.05 raised to power minus 5 minus 1 divided by 0.5. Then you have 4.3295. Then in the 5th year, 1 divided by 1.05 raised to power 5. In the 5th year, you have 0.7835. The present value, our present value, then 8 times this, 8 times 4.3295, and that will give us 34.636. Then we also have 2.4 times 4.3295, and that will give us 10 point, so it's negative 10.3908. I put this in braces because this is negative. Then in the 5th year, you have 112.20 times 0.7835, and that will give us 87.9087. So the net present value of that, the net present value, and that will be minus 10.3908 plus 34.636 minus 85. So we have net present value of 27.1539. This is positive net present value. So you will need a negative one. To calculate the negative, since the first NPV is positive, you assume a rate that is higher than that. So then we have year, items, cash flows. Year 0, an item, we have the market value, which is $85. Year 1 to 5, we have interest of 8%. Year 1 to 5 as well, we have the tax savings on interest, tax savings, and which is 2.5, that is 30% of 8. And the 5th year, we have the conversion value, and which is 112.2. So now let's try 10%. We need -1. So let's try 10%. This will be 1. The PV will be here. So now, what will be the cumulative discount factor using the annuity formula I've given? The 10%. Okay, 10% might not be negative. Let's try 14%. Let's try 14%. So 1.14 raised to power minus 5 minus 1 divided by 0.14. So we have 3.4331. 4331. 3.4331 for the 5th year. So for the 5th year, the discount factor will be 0.5194. What will be the present value? Our present value, this will be $85 negative. Then 8 times 3.4331. 8 times 3.4331. That gives us 227.4648. Then 2.4 times 3.4331. Then we have 8.2394 negative. Then 112.2 times 0.5194. Then we have 58.2767. 58.2767. So 58.2767 minus 8.2394 plus 27.4648. We have then minus 85. Then we have minus let me recast it. 58.2767 minus 8.2394 plus 27.4648 minus 85. Then we have minus 7.4979. That is negative. That is our net present value. So we've calculated our net present value and it is negative. So having computed the two NPV, one positive, the other one negative, then we now want to calculate the internal rate of returns. We want to calculate our internal rate of returns by interpolation. IRR equals to lower rate plus NPV at lower rate over NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. Now, the lower rate we have assumed is 5%. The NPV at that, and we got NPV at 5%, we have 27.1539. 27.1539 over 27.1539 minus NPV at higher rate, and we have a minus 7.4979 minus 7 point, so we have minus 7.4979 into higher rate. Our higher rate is 14% minus lower rate, which is 5%. So now we have 5% plus 27.1539 times 14 minus 5, that will be 9, all over If you have 27.1539, the minus and minus become plus. Plus 7.4979. Then we have 34.6518. So we have 5 plus. So if you have 27.1539 times 9 divided by 34.6518, we have 7.05. If you add it to 5, then you have 12.05%. That is our IRR. So that is the cost of convertible loans. So the last one I'm going to examine is the cost of traded loans. Not traded debt. I've given you examples of not traded debts that we have bank loans. Bank loans and other not traded fixed interest loans, we simply need to adjust for tax relief. So cost of not traded debts or loans, just adjust for tax relief. You have cost of not traded loans. So we have interest into 1 minus tax rate. The T stands for tax rate. So we want to solve the question above. If you go through the question above, we were told that a firm has a fixed rate bank loan of 1 million. It is charged 11% per annum. The corporation tax rate is 30%. What is the post-tax cost of the loan? So the interest rate is 11% and the tax rate is 30%. So the cost of the loan, so you have 11% as the interest rate into 1 minus tax rate, which is 30%. So we have 11 times 0.7, and that will give us 7.7%. That is the cost of the loan. So 7.7%. Please don't forget to like and subscribe to keep up with my upcoming lectures. Thanks.